going to figure it out. It's going to be great. Hey, welcome to the Closing Beat, everybody. Happy Monday. How you doing out there? I said I was going to do it. I'm going to do it. I'm going to do it. I'm Dustin Tibbetts, and I just got 2 words for you. Let's get started. Come on. Oh, that's too funny, man. Or I'll take Doc's thing. I got 2 words for you. Let's do this. Huh? Hey, anyways, we're financial advisors here with Jazz Wealth, obviously a little bit lighthearted, but we take our finances seriously, as you see in our classes, our emails that we do over the weekends. Last week, our Wine and Wealth class was learning to think strategically about your dough. Got to do it, man. Not thinking smart and being cool and budgeting and all that. Strategery. We went over a whole bunch of different scenarios that I promise you nobody's ever really told you before. And so we went through the details of how to do that. So if you want to join us here at Jazz, you of course can do that, jazzwealth.com. Our notes from Jazz this weekend, we did a bull-bear case. We talked about bull market potentials. Wow, could we be bottoming? And a really spooky reason why this could be a horrible bear market. What's the problem over there? We sound good? We're good, right? Yeah. It's good. All right. He looked frustrated on a Monday. And anyways, our FinTips videos this week, they're free. They're available on our YouTube channel. Of course, you can participate in that. We just ask that you subscribe and everything there. I took a different approach. My video, the one that I'm putting up, is focused on the opposite of what everybody's saying, doom and gloom and the Fed and everything like that. My video was, let's pretend the Fed's getting it right. Let's look at that soft landing approach. So a little bit of a lesson there and to kind of explain how things go. But before we get started, it's better on the volume. That's good news. Before we get started, we have a breaking news event here. We're going to actually go on over to Eric, who's standing by in our speakeasy room for us. Eric, I believe, has some breaking news for us. What do you got, Eric?
Hello, yes, breaking news coming out from the IRS. They said that they have made a final ruling on the RMDs that came through with the Secure Act. So what's going on right here with the Secure Act? It looks like we are going to have to take the inherited IRAs, and you're going to have to take the RMD each year once you've inherited the IRA, if you did that during 2020 or after. Now, the thing about it is, though, is that for anybody who had the RMD they were supposed to take in 2021 and in 2022, it's been waived. So the nice thing is they're not going to be doing any taxes on or a penalty on that of 50%. Am I good? Am I good? Can you hear me?
You look good to me, man.
Okay.
You look good.
Cody's throwing me off over here. I'm trying to make sure everything's good. Producer Cody's kind of making me nervous. Like, am I too hot? Am I not? All right. So the idea is they're actually going to not penalize you for not taking the RMD for 2021, 2022. But the problem with this whole thing is we don't know if you still have to go back and actually take the RMD for 2021 and 2022. So we're still waiting on a lot of ruling. So who knows what's going to happen with the IRS and what they end up doing there.
It's a joke. It's an absolute joke. We've been fighting that in the advisor world for 3 years now.
Yep.
About 3 years.
Waiting on some answers.
And we finally got some answers there. So I just wanted to bring that to you. Eric will do a full video on that to keep you updated as to the details there. So be on the lookout for that as a FinTips video. So there you go. Good. You look just like they do on TV, man. You're sitting there. You're like, oh, they cut over to me, looking good. You're cut off.
I was hoping to do like the earpiece thing so I could.
You're gone, man. Volume's off. You're gone. It's it. He's it. He's out of here, man. Anyways, let me go like this. Make sure you guys can all hear me. We're just playing with things, right? We got some new tools here. We're just playing around. What we're not going to play around with today is some of the geeky lessonry, right? Remember last week we went over things that maybe you've never seen before, right? We're going to do the same thing here today, but we're going to start with the old stock market, and we'll get to that good stuff. So you ever thought about using options as a hedge against your portfolio? You know how they say buy puts to hedge your portfolio. If you've ever taken any basic finance class, they say that. Is that the right thing to do? I had a whole bunch of time on my hands this weekend, so I'm going to share that study with you and probably save you some money there. Anyways, as far as the markets go, Fed members basically out in force again with Jamie Dimon, I will say, the JP Morgan CEO there. The Fed is saying inflation remains their top priority, even if it costs you your job. Those are their words, not my words. I'm not making it up. I'm not trying to spook you or anything. They say inflation is the number one concern, even if it costs you your job. They're going to do whatever it takes. So they're kind of setting the tone for the next rate hike there, which is fine there. Now, as far as the stock market goes, I'll tell you, we were actually up overnight. If you look down here, the futures markets were actually up overnight, looking pretty strong, and then they just faded away. Really, really tough night there. You wake up today, you see it's all weak again there. During the day, and I'm going to use the SPY to share this with you guys. During the day, we made a decent attempt at rallying, right? So where'd we go here? Right here, right? We briefly almost turned positive as we went into lunchtime, really after that. So if I put my line right here, here's the close, right? We're going to go right over here. This is extended hours. Bam, right there. So there's the close from Friday. Look over here. See if I can slide over without dropping this thing. Look at that. We bumped our heads up against the prior close. That's a known resistance area for day traders. They love using that. And so we bumped our heads against it. Couldn't get it done. Right at the end of the day, they gave up. So just bam, we're back bunching against the ceiling, right? Just trying to punch it. Couldn't do it. We find weakness there into the end of the day. So it's not a good start, or not a good finish for how we look to start tomorrow, but we'll see what happens there. I just thought I'd point that out to you. If you're looking at the NASDAQ, it's going to be a very similar picture there. It was positive, actually, at one point overnight. The Dow can say the same thing, but ultimately they finished down on the day. Gold down 33 points, continuing to pull back, though not as bad as the stock market. So if you're looking for that relative strength pullback, maybe some gold stocks in there, I don't know. Looking at oil, finally pulling back a little bit after its monster move last week. Everybody's trying to digest the impact on gas prices of the Saudis increasing by 2 million barrels a day. I'm sorry, cutting by 2 million barrels a day starting in November. The bond market, here's some good news for you. Bond market was closed today. So interest rates couldn't go up, right? We know that this is almost the worst year for bond markets. Just brutally hammering any conservative portfolio, any sort of no risk target date fund, 60-40 portfolio, anything like that, just brutally just demolishing that. Anyways, bond markets are closed, so they could not fall again today. I believe they're already indicating a little bit lower going into tomorrow, so rates may be a little bit higher there. Other than that, you know what I mean? It kind of a slower start to the week. There's a lot that's coming out. We've got earnings season starting on Friday with the big banks and a couple others. We have the inflation numbers coming out here Wednesday, so there's going to be some action. But today, not so much, not as volatile. I do want to point out a couple things here. Earnings-wise, Pepsi is one of the first up. I thought it was interesting, staying away from the banks there. We expect them to beat on earnings, beat on revenue. I did some homework over the weekend because I think they're going to report higher organic growth, which is going to offset the drop in their total margins there. So I think that's what you're going to find there. And based on Brazil's economy and how things are going over there, I think you're going to find the highest organic growth in Latin America. They do break it out by segment there. And it'll be fun to see the response to Gatorade Twitch. Gatorade Fast Twitch. It's a caffeinated Gatorade, like highly caffeinated Gatorade. So that's that. I thought that'd be cool to look at. Other than that, you're going to start looking at Fastenal, American Express, Bank of America, JP Morgan. The big banks are going to report there. We've already talked about some of the impact on lower asset management fees, hopefully being offset by credit card fees and maybe mortgage maintenance fees and things like that. We'll see. I don't know. It's all going to come out, right? So we're going to know what we're looking for there. I'll mention a couple others because I was just digging around doing a lot of kind of fundamental research this weekend. Steel, any steel stocks, Nucor, U.S. Steel, you may look around there. Steel Dynamics is another one you may look around. Look for weak earnings in the steel category, I think anyways, and I'm just throwing out some projections. These are just pure guesses, right, based on what I was looking at. We got prices dropping. Right? We've got higher costs in general for them and for everybody who, we're all dealing with that there, and potentially a slowing down of an economy. Maybe, right? We're maybe working on that now. So could be tough for them. Nucor, they're building 3 plants at the moment. So if we're looking for updates on that, I believe it's North Carolina, it's in Kentucky, and it's all right there. Kentucky, North Carolina, Virginia. We'll see what's going on there. U.S. Steel is likely to miss on earnings, so no shocker there if that happens. They've got a high cost of inventory that they still have. right? And this is no different. You may say, I don't like U.S. Steel. It's boring. I don't want to do. Well, this is the same if you're looking at, Levi's, Home Depot, anything like that. They've got a lot of inventory on their books. And so if their inflation projections are flat to, neutral, then that means that inventory continues to cost them more and more. So I believe that's going to cost them. They'll probably miss on earnings. Steel Dynamics, STLD is a ticker symbol if you're interested in there. They're likely to beat by a wide margin, at least compared to others in their industry there. The length of, like the home builders, they have a backlog of business. So the backlog for what they would, it's not home building, but for them, it's their fabrication business. Their backlog in that segment of their business is dramatic. It is incredible there. So we're looking for updates on that, updates on their pricing. And obviously for any steel company, we're looking for the overall demand outlook there. So interesting to check out. All right, let's go on to some other stuff. Just testing ideas. You tell me what you think there. I thought I'd go through some earnings stocks and see if we can maybe throw out ideas that, to show you what might happen, right? Who's expected to beat and why is that? Sector-wise, I want to point out something real quick here. How can you tell things are really, really bad in the general stock market and economy when the most defensive of defensive sectors goes from 52-week highs to 52-week lows in a month, right? That's how you know things are really nasty there. Here's the good news. When the most defensive sector goes from highs to lows in a month like that and dramatically sells off, you have a recipe for a market bottom. Most of the time when that happens, the stock market's near a bottom. And I'm just trying to show you these things just so you maybe find some positivity in the world. It seems pretty negative right now. When the utilities fall by 10%, here's your in black, the returns going forward, which by the way, beat the stock market returns. So it's just call it above average bounces. And the same is true when we're down over 15%, which is exactly where we're at now, down over 15%. So it could be the reason why we find that this is the case is because defensive players have thrown in the towel, just like the rest of the world, like the last sector you can trust and want to be a part of, you're throwing in the towel. That tends to mark a bottom there. It could also be sector rotation into other sectors, but we don't currently have that at the moment. So in short, you have the most defensive sector right now selling off as if it's a tech sector, right? It's not a leading sector. It shouldn't be doing this. And when we look forward, we see that the returns are so positive going forward, it tends to mark a bottom not only in the utility sector, but also in the stock market in general as people throw in the towel. And we'll see what happens. These are the things that I keep that we're going to track with you guys and see how they do going forward. All right, I promised you something interesting here today. Not that that wasn't interesting, but let's take a second and talk about hedging your portfolio using options. And today I'm going to talk about just puts, right? The most common and simple, easiest way to hedge a portfolio. You have 100% stocks and you go, I'd like to hedge 30% of that. I'm going to buy some puts either on the individual stocks or on the index itself in hopes of offsetting a decline. In other words, the value of the puts would go up as your portfolio goes down or some portion would go up and help offset some of the declines. To understand that, let's talk about this cool little thing. This is not my chart. I just stole this offline, but we're going to talk about standard deviations. In statistics, you can take a number of occurrences and you can usually find that 68%, if you just plot them over this bell curve, meaning the weakest on the left, the strongest on the right, 68% occur within one standard deviation of the mean. You find that 95% happen within two standard deviations. It's actually a fun study where they actually flipped a coin, but they flicked it, right, to see what would happen. 95% within two standard deviations of the mean. In other words, it would be very rare for something that you're plotting, some sort of sequence of returns, to occur outside of this. 99.7 will happen within three standard deviations. If you don't get that, that's just a simple little overview. Maybe you can learn a little bit about that. If we take the S&P and fill it in with all this so it makes more sense, this is not mine. I took this from offline, but I'm just trying to show you what this looks like first. So here is all of the daily returns in a given period. And in this period is from 2005 to 2020. So the majority of returns happen right here at basically plus or minus nothing, just a little gain, little loss. 0.09% is the average daily gain in the stock market, so we know that. And we say, okay, there are days we have some better ones, but There are less frequent days where we have these massive days that are 2 standard deviations out, 3 standard deviations, etc. And there are less days, but there's still more than the gainers. There are less days where we have massive losses. Okay, cool, right? We understand that. The majority of your gains will fall within the same general area there, right? To put the math talk aside for a second. Now look over here. On the right side, there's very few days that extend itself outside the bell curve. There's very few days that do the same on the downside. However, there's a few more, and that's because fear always overrides greed. Just normal market behavior. We always are more fearful than we are greedy, right? We tend to look away when things are good, not be greedy. We tend to look right at the market when we're fearful and make stupid decisions, right? Here's the problem and where I'm getting with this. Let's see how many 2, 3, 4 standard deviation days there are. And in this case, I'm going to use 3 standard deviation days. The number, don't let it scare you, right? The number of 3 standard deviation days is increasing. The dark blue is positive days that fall at 3 standard deviations or greater. The light blue are the negative days, right? Remember, just like on this chart a second ago, there are more negative days than positive days that fall out towards the outsides of the curve, right? So this is the problem. We find ourselves at a point where there are many, many days that are outlier events. What are options used for? Options are used to predict or hedge against outlier events, right? And so we've got a lot of these. So the question of should I use options to hedge my portfolio is a natural question. Look at the volatility, right? More days than normal are outlier event days, days that we just shouldn't be expecting. Remember in 2019, right? We basically just had a quiet year. We didn't even have 5% pullback. We got used to that quietness down here, no real outlier days. Then all of a sudden 2020 comes along, we got the virus. It seems like all hell's broken loose, right? No, it's just those are more outlier days. Anyways, let's go and say you want to use options as a hedge, in particular buying puts. What I found is you better be really accurate, right? Otherwise it's going to cost you. And this next slide is going to scare you a little bit, but let me explain. I started simple and then I went crazy and sorry. Okay, here is every single day of you buying a put option since 1987, as far back as I can go. So every single day, you take the day that you buy the option and then we look forward to see what was the return of that option up till expiration. It's actually a pretty easy thing to put together, but here's what we're looking at. On the bottom, apparently I spelled it wrong. This is the S&P performance. If we move over here, the performance is positive, right? If we move over here, the performance is negative. Now, on this y-axis, if we go up, the return of your hedge was positive. If we go down, the return of your hedge was negative. As you can see, any point where the market was moving lower and you hedged, the majority of events are down here. You lost money on the return. But I noticed that there were these clusters that did really well, so we broke them down by date. This is COVID-19. Remember how wild that was? That was a massive outlier event, right? And your hedge paid off. Here's the tech bubble, which I didn't spend a lot of time on, but this is the whole tech bubble period there where we went through the dot-com crisis and that wonderfulness. Your hedge paid off a little bit, but your timing had to be perfect because look, if your timing was a little bit off, your return on your hedge was next to nothing. All the while, the stock market was going down. So your hedge cost you money, which means it cost you returns. The financial crisis, all through 2008 and everything, you got the same issue there, right? You got to be very, very, very cautious about what you do in terms of hedging your portfolio. And what I mean by that is you better be pretty darn close to the beginning of outlier events. I'm not saying you need to be close to the top. Notice that. You need to be at the beginning of the start of these outlier events in here, right here, or you're going to spend money to hedge your portfolio. So in short, what that means is if you look at your total outlier events increasing and you say, oh my God, I'm going to hedge and let's do this here, you're likely better off to just sell off part of your portfolio, right? Just go 30% in cash instead of hedging 30% of your portfolio. Then it can't cost you money to carry that hedge or that insurance there. So really, really interesting there. You better have impeccable timing, or using puts really, this doesn't make sense to do. Generally speaking, if you're going to throw darts, that sort of thing. All right, boy, I tell you, you give me a couple days off and I do these sort of things. Okay, stocks in the news, right? And you got to type the right symbol. There you go. Here's BlackRock. These guys they're getting pulled through it a little bit. They're getting green. They're getting really progressive in their focus on green energy, ESG investing. They've put a real focus on that. They've forced a lot of their clients to go into these ESG funds that they've built. And because of that, what we found out is that they've lost $1 billion in fees from people moving outside of that. $1 billion to focus on ESG. I'm not against it. I'm not for it. I just happen to notice that nobody ever asked me for that, right? Had thousands of people here at Jazz. They never asked me any questions about that. So I wonder if that was a slick move or if that's going to continue to cost them. Rivian, you may have noticed in the news there, they're recalling pretty much every car they've ever made, which thankfully is not the size of Tesla there. Got some steering issues, and it's not the end of the world there. It's not life or death, it appears, but they do have a recall there. And if you're a company that doesn't make any money, and now you have to spend more money fixing these recalled cars, well, that's probably the reason why the stock was down a little bit today and maybe going through a little bit of trouble. You got Merck in the news there. I didn't get a chance to look at this. It's a hypertension drug. This is the reason it spiked today. They're in their third phase. See if I can find the drug name for you. I forgot. My eyes gloss over when I look at this stuff, but I'm really trying to get better at it. I can't even say the name of it. Sotriceratops. I'm going to go with that. Anyways, that's the reason the stock is higher today, because of positive data from that, and that's good news. These are tough stocks to pick those days when that happens, but if you do, nice little pump there. Apple trying to get rid of the antitrust lawsuit they've been dealing with not Alliant, Affinity Credit Union there. They're trying to work their way past that. Not really stock moving news today, but there wasn't a whole lot of stock moving news to report. Illumina, there you go. They're in the news there. This is cool. So these guys are focused on gene sequencing, and they're able to do it now cheaper. I don't know enough about it. I'm going to be honest with you. I find it's very fascinating. I don't know enough about it. The thought process here is mass, right? Lower cost gene sequencing, more gene sequencing being done. Maybe they can make a little bit of money off of it. The stock didn't really move today, so not much to work with there. All right. I will attempt to answer your questions. Again, just testing a few things here just to see what sticks, see what you guys like. And if you have any questions, I'll let the stream catch up and get things going there. Digital Haze. He's an investor, trader, just want to make some money. There you go. Yeah, call yourself whatever you want, right? As long as a few dollars are making it into your account. People can call you lucky for all you care, right? I like it. Yeah, ESG's been incredibly popular with the asset managers, wealth managers, investment banks. But I don't think it's so popular in mainstream where people say they want to be a part of that. And I don't think it's because they disagree with it. I think it's not a very clear product at the moment. It's just kind of hard to understand, right? For example, I saw on Etsy, Goldman Sachs upgraded Etsy, and then they break it down by why they made different suggestions. And in the ESG section, they put that Etsy owns Depop. Is it Depop they own? It's an online, sell clothes online. And so their ESG argument was that because the end user is selling used clothes and the other person is buying used clothes, well, that's better for the environment because you're not making new clothes. That's how we come up with that? It just seems like, oh, okay, we're reaching for ways to call this an ESG thing. So, yeah, I don't know. I think it's just not clear what all that should stand for and what's going on there. You headed out? No? Still go? You got something you want to say? Anyways, that was the ESG thing there, but we'll see. I mean, just has to be more clear, I think. What's the news on PayPal? Something come out after hours? I do not know. I was rambling on about what I was rambling on about there. Oh, that was that. Was that fake news? No, it wasn't fake news. So over the weekend, I read this that PayPal was going to implement new policies where if they found you were providing misinformation, they were going to deduct up to $2,500 from your account. In other words, a financial penalty for spreading misinformation. And, you know, who knows what misinformation was? They were not clear on that. It appears that PayPal has come out and said, we'd like to retract that because of boycott PayPal trending on Twitter over the weekend. PayPal will not be fining people for misinformation, and the language was never intended to be inserted into our policy. Appears they just said it for the sake of saying it. They didn't actually mean it. So that's what was going on there. I thank you for reminding me about that. That was fascinating because I read that and I thought, that's probably fake news. That's kind of a silly thing to say or even do. But there's your news. Yeah. So they're changing their tone on that one. They apologize. Yeah. That'll get Cody fired up, huh? Well, that's what wasn't clear about it. It was just like misinformation, and people were like, "What? So I type something on Twitter, you're gonna ding me $2,500?" I had a feeling that might get some backlash. I just thought it was fake. I didn't think it was real. Wow. Yeah. Thoughts on Twitter's effect on Meta's future? Meta is very, very focused on their version of the metaverse, and they're spending tons of money on that. Twitter, if the deal closes with Elon Musk, he's already said his goal is to make it the everything app, which would not include the metaverse because that would be too costly. His idea literally is to just copy WeChat over in China. You got to look it up if you've never seen it before. In China, they do things a lot differently. You know, you have one app for everything, whatever you want to do. It's just one app, and they all kind of compete for your business. But I don't see that going into the same thing that Meta's working on. No, no, no. It'd be Meta and Microsoft be going at it there. Yeah. Don't you kind of agree? Yeah, Tay's like, hey, that WeChat's great. I would agree. I think we are way behind on that sort of thing. Hey, you want to go live? Oh, you want to buy something? Or you want to call somebody? You want to do something? It's like right there. Save you a lot of hassle, which is, if, you know, anybody can do it, maybe Musk can do it, but got to close on the deal first. The only reason they retracted the idea is because people caught on. You're probably right, right? If we would have all done like I did and just been like, it's probably not true. Yeah, I'll bet you that would have made it into their language, huh? Yeah. Yep. Glad that I brought up X, huh? There you go. Well, I hope you don't own it yet. I think it's going to be a miss on their earnings. What do you think of Jamie Dimon's comments today? 10-20% more downside. His comments came, so that's the clip that you saw. Remember, what you see is not always what was said. That was the clip that came in response, basically, to Fed comments that they're going to do whatever it takes to fight inflation. His belief is if they really do whatever it takes to fight inflation, you're looking at towards the end of 2023 before they can get it down to 2%. I even showed that to clients. We did best case scenario, how fast can they get inflation down? You're looking at the end of 2023. That means you have interest rates you have Fed funds rates in the 7 range, which I don't really think so. But anyways, you get up to that case there, and yeah, that's a great reason. You're absolutely 20% lower in the market, if not more. Yep. What's the prediction on inflation on Wednesday? I had 8.6. I let the news and everything get the best of me, but I'll stay with the 8.6. I'll stay with it. Yep. Looking at 2 times grocery bills. I'll probably make a video out of it because I tried to make one of those YouTube shorts out of why your grocery bills aren't going to go down with all the geeky data and stuff. But I think it deserves a little more time than 60 seconds. So maybe I'll do that. Yeah. Yep. All right, I'm going to wrap it up there, get back to doing what I do. I hope you guys enjoyed today, learned something a little different. Again, maybe some of these things that I throw out there are just a little advanced. But shouldn't you always be learning something that's just out of your reach? Like if you're learning something you already know about, then you're not really learning, right? So learn something, just listen to things that are a little bit out of your reach so that you push yourself a little bit more. That's what I'm trying to do here. If it causes more questions, so be it. I'm happy to answer. Enjoy the rest of your day. We'll see you tomorrow, and thanks for watching and subscribing. Adios.